So StoneX just reported earnings, and wow, did the market hate it. But here's the thing. While traders were hitting the sell button, management was telling a completely different story, one about a huge, game-changing future. You got this massive disconnect. So what's the real story here? Is the market right, or is this a huge opportunity? Let's dig in.
All right, here's the plan. We're going to start with that harsh market reaction, then look at the actual numbers that caused all the noise. After that, we'll dive into what management is planning, this big transformational bet. That'll set up the two competing stories here, and then, of course, we'll give you our take. The next call.
Okay, so let's jump right in. We're talking about the market's verdict here, and believe me, it was harsh. The street didn't just dislike these earnings, they absolutely hammered the stock.
So just how bad was it? Try this on for size. A 15.5% drop in a single day. We're talking more than $15 a share just vanished. That's not a small dip. That's a signal flare. Wall Street was clearly, and I mean clearly, spooked by something. And look, this wasn't just a few nervous investors selling off. This was a stampede. You can see the trading volume here just exploded, almost 3 times the normal daily average. That tells you something really important. This wasn't retail panic. No. This was the big money, the institutions heading for the exits with conviction.
All right, so what on earth caused that kind of sell-off? Let's get into the numbers behind all that noise and figure out what exactly went wrong in the Q3 report.
Okay, the main culprit, a good old-fashioned earnings miss. The headline number, GAAP earnings per share, came in at $1.22. The problem is, Wall Street was expecting something closer to $1.40. I mean, missing by 12–13%? Yeah, that's always going to get a reaction from the market, and not a good one.
But there's a pretty big but here. The CFO, Bill Dunnoway, basically laid it out for everyone. He said, hey, look, we had almost $9 million in charges related to an acquisition. And get this, that alone accounted for 12 cents of that miss. So a huge chunk of it was a one-time thing.
You know, when you peel back the layers, it's really a tale of two companies inside one. On one hand, their institutional and retail businesses were on fire. I mean, revenue up 27% and 18%. That's fantastic. But, and it's a big but, all that great performance got completely wiped out by their commercial segment, which just cratered. Revenue dropped 24% thanks to things like lower commodity volatility and tariff headaches. Okay, so that's the bad news that the market fixated on. But here's where the story gets really interesting. While everyone else was looking at the last 3 months, management was trying to get them to look at the next 3 years. And this all centers around one massive move, the acquisition of R.J. O'Brien. Now, management isn't just calling this a big deal. They're calling it transformational. And why? Because with a stroke of a pen, StoneX became the biggest non-bank futures commission merchant, or FCM, in the entire country. That is a huge deal.
So really quick, what's an FCM? You can think of it as the plumbing of the financial markets. They're the ones who handle the trades for futures and options and hold the money for clients. It's a critical role. So becoming the #1 non-bank player in that space, that gives StoneX some serious muscle and a dominant position.
And they're not just winging it. They actually came out with a clear timeline. It's like, okay, in the next 3 to 6 months, we're integrating the international part of RJO. Then over the next year, we tackle the massive U.S. business. It's a very deliberate step-by-step plan to make this whole thing work and create value.
So this is what it all boils down to, right? You've got this incredible clash of perspectives. It's the market's view versus management's view. And they could not be more different right now. And this leads us to the billion-dollar question, doesn't it? Is the market seeing something that management isn't? Or is the market so focused on one bad quarter that it's completely missing out on a company that's about to transform itself? So in one corner, you have the market's short-term view. They're looking at the EPS miss, the weakness in the commercial business, and they're worried about the risks of pulling off this huge integration. Fair points. But in the other corner, you have management's long-term vision. They're talking about game-changing synergies, a more resilient business, and their new spot as a market leader. Two totally different stories. All right, we've looked at the numbers, we've looked at the strategy, we've seen both sides of the argument. So it's time for our take. It's time for the next call. So what's going to decide which story is the right one? Well, here are the key things you need to be watching. We need to see real, tangible updates on how that RJO integration is going. Are the synergies real? We'll be watching to see if they actually use that new share buyback program.
And, of course, any big shift in interest rates or volatility could change everything. That year-end call in December? Yeah, that's going to be a big one.
Okay, so here it is. Our rating on StoneX is outperform. We think that 15% drop was a massive overreaction. The market panicked over some short-term headwinds and, in our view, completely glossed over a deal that changes the entire future of this company. We believe the long-term value here is just being ignored. So for us, the question isn't if the market will catch on, but when.
And as always, just a quick reminder that this explainer is for informational purposes. This is not financial advice.